On April 20th, 2020, the impossible happened. Oil, the lifeblood of the global economy, the commodity entire nations fight wars over, fell below zero. For a brief chaotic moment in history, a barrel of oil wasn't just worthless, it was a liability. You practically had to pay someone to take it off your hands. To understand how insane that is, imagine walking into a gas station, filling up your car, and the cashier paying you $50 to leave. It sounds stupid. It sounds like a glitch, but it wasn't. It was the moment the modern energy market broke. In early 2020, the world was locking down, airlines grounded, highways empty, factories silent. Global oil demand collapsed overnight. The world didn't just need less oil, it didn't need oil at all. Tankers floated offshore with nowhere to unload. Storage sites filled up to the brim. Every barrel pumped out of the ground had one question attached to it. Where do we put this? For decades, traders on Wall Street treated oil contracts like a bet. You didn't buy the physical oil, you bought the right to receive it later. It was mostly financial. You were never supposed to actually take delivery, but there was one rule every trader understood. When the contract expires, someone has to take the barrels, someone has to store them. On April 20th, no one wanted them. The May futures contract for West Texas Intermediate crude was about to expire. Traders holding those contracts suddenly faced an ugly truth. If they didn't sell immediately, they weren't left with a number on a screen. They were left with real oil, thousands of barrels, and nowhere to put them. Panic hit the market like a shockwave. Traders didn't care about profit anymore. They cared about escaping. They sold at $5, then $2, then $1, then $0. And when $0 didn't clear the market, the unthinkable happened. The price slipped into negative territory, -1, -10, -20. At the bottom of the chaos, oil hit -$37 a barrel. Think about what that means. If you were willing to accept physical oil, traders would pay you $37 for every barrel you took. They weren't selling oil. They were begging for storage. Screens turned red. Algorithms malfunctioned. Traders at home in sweatpants watched their positions dissolve in seconds. A handful of small investors, using apps that never warned them oil could go below zero, ended up owing more money than they ever imagined. Some accounts went deeply negative. People were wiped out instantly. Meanwhile, supertankers set off the coast of California and Singapore, transforming into floating storage lockers. Their cargo wasn't fuel. It was a symbol. A reminder that the global economy wasn't just slowing down, it had slammed to a complete stop. But the craziest part is what happened next. Just days later, oil rebounded back above zero. The physical panic faded, and everyone suddenly asked the same question. How did this happen in a market worth trillions? It happened because modern finance isn't built on physical reality, it's built on expectations, algorithms, futures, leverage, layers of bets on top of bets. When real-world demand disappeared, that entire structure was exposed. Oil didn't go negative because the world ran out of value. It went negative because for one moment, the system forgot what value even meant. And that's the terrifying lesson. When the world stops, markets don't bend, they break. And when they break, the numbers on the screen don't mean anything until they suddenly mean everything. Thanks for watching. If you want more breakdowns like this, make sure you're subscribed. I'll see you in the next one.